All right, so today is Tuesday, July 30th. Basically week 4 of our class. And what I'm hoping that we will accomplish today is to pick up where we left off in our last class with the as-is valuation model of Nvidia. Talk through the other 3 models and kind of talk through the bull, the bear, and the target. Then we will do a practice using that model to value Walmart in class today, kind of following through the whole process, and then set you up for next week's homework assignment, which will be to do a valuation of Costco. We're using the model for another company, just kind of practicing several attempts at the valuation. So that is what is on deck. Before we go further, general questions about anything? Was everybody able to get to the model that we finished in class last week? Any big issues with that? Because we're going to be using that pretty extensively today and for future assignments. All right. So let's talk about where we kind of finished and where we're going in the process. File from last week. Let's see if I can share. All right. So where we are right now is we have finished up a as-is valuation of Nvidia based on the share price at the time of the valuation last week of 122.59. And so essentially we have matched that share price using this DCF model, kind of working backwards. So the idea is intrinsic value, worth the sum of your future cash flows. So those cash flows lead to a value / price. In this case, we know the value / price of the company, and we're trying to figure out what are the cash flows that represent that valuation, right? And that is a process known as the as-is, right? And so to get to that valuation, what we primarily did is using the earnings estimates from the consensus on Wall Street. We put in 5 years of revenue and EBITDA to get our revenue growth rates that Wall Street's forecasting for the next 5 years, as well as the EBITDA margins that Wall Street is forecasting for the next 5 years. We put that here into the ratios. So these are the growth rates. These are the expected EBITDA margins. Slightly smaller. Small fits here. We then looked at, based on the company guidance, the expected tax rate that the company was going to be paying in the future, which are the 3 most critical elements of gross cash flow when we forecast operating free cash flow. We left currently the balance sheet ratios alone, so that the company's balance sheet grows at the constant level of productivity for the operating assets with the growth in sales. We didn't see any need to really change that. We then had to estimate kind of the perpetuity numbers. So these were the first 5 years that we had forecast, primarily driven by the ratios. And to estimate the perpetuity, the big number we needed was an EBITDA and an operating income / EBIT in perpetuity as a margin. And so what we did on the assumptions is we used the trading multiples, EV to revenue and EV to EBIT, that said if we divide the two, that gives us a range of what the perpetuity EBIT margin likely is based on the trading multiples of Nvidia at the time of the valuation. So somewhere between 64% and 66% is the perpetuity EBIT / operating income margin. We couldn't change that here because that's a white cell, and it is driven by the two cells above. So we basically put in an EBITDA that got us that operating income margin in that range. We chose the middle of the range, so 67.5% EBITDA margin. Now, eventually, this 1 year of growth in 2030, like we need to come up with something. But what really matters, kind of left it alone. But what really matters is we then had to figure out what the very long-term growth rate is for Nvidia. Okay, so this is the perpetuity growth rate. It's not a 5-year growth rate. I think it was like a 30-year average growth rate. And so from a process standpoint, what we did is we used GoalSeek to say, okay, if back to key value drivers, right? Key value drivers say that, long-term, the value is the ROIC, the WACC, and the growth. Okay. And so the idea is we kind of know the WACC because we're using a constant WACC in our valuations. I mean, the capital structure doesn't change, pretty common practice. And so ROIC in perpetuity is a little bit easier to forecast growth in perpetuity. So a lot of what we've been doing in the model is to try to come up with, essentially, by putting in all these numbers, an ROIC, and then we kind of solve for the growth of that ROIC that equals that share price. And we did that using GoalSeek. So when we did that, we came up with a G of 10.73%. Remember, whenever you do this process, that perpetuity G can never be higher than your WACC. That would be a math error, right? Our WACC right now at 13.8, G 10.73. So we didn't trip that red flag. And that gave us, at a 10.7% G, very high ROIC, given these numbers and margins, that gave us a model share price of 122.59, which matched the observed share price last Tuesday of Nvidia. So just kind of summarizing at a very high level all the steps that we went through, and these are steps that you'll need to repeat. Again, pause. Questions? Spencer?
Yeah, I noticed if some of our assumptions were slightly off, we could still get to the same 10.73 because of the excess cash. Like, I guess my question there is, do we have to make sure our assumptions are always in line with this model for this class, or can we just justify our assumptions?
So there's two answers. I'll start with the second. For this assignment, I wanted you to be exact. I didn't want to have any deviation. And that's really just more of a validation that says, if you were to get what I got, that means that you created a proper model. If you had some deviation from what I got, there could have been some things that you did along the way that could have been a potential challenge with your model. And so it was really just a way to make sure we all had the same model. That being said, your first question is also correct, meaning, and I'll answer in terms of key value drivers. There are different growth and ROIC combinations that lead to the same results. Okay. So when we're creating a valuation, we can have slightly different growth ROIC combinations and still come up with the same answer. And so that's to some degree the point of the as is, meaning I can tell you this as is that the G that most analysts use are probably around 10%, plus or minus a little bit, but it could be a little lower, which means the ROIC is a little higher. Somebody else could have a slightly higher G with a little lower ROIC, but somewhere in this reasonable range is where we need to end up. So when you're doing your next assignment, 40 people are not going to have the same G ROIC combinations, even your as is. But if, for example, if it's 10.7, like you should have, somewhere between 10.5 and 10.9. You shouldn't have 6. All right, you shouldn't have 7. That wouldn't be reasonable for an as-is valuation. Does that make sense or answer the question?
Yeah, that makes sense.
Okay. Theodore?
Professor, I turned in the model that we saved before the as-is portion. Did you want to see the as-is calculations too?
I expect for the homework assignment that's due today that you turn in a model that looks exactly like this with a share price of 122.59 in it and all this at the bottom. Because
Okay.
that's what had to be completed in order to kind of continue, including what we're about to do.
Yeah, I have that. Can I resubmit that with
If you
just
submitted the wrong version, yes, just send me, you won't be able to submit anymore. The link is closed. Send me an email explaining what you did.
Gotcha. Thank you.
Sure. All right. So hopefully everybody has this file open. And we're going to kind of proceed from here unless there's any other questions about the as is. And I'll give you one more opportunity. I'll show you one more thing. This is the other point that I was trying to make last week is when you look at any company, and Nvidia is no different, the operating value is the majority of the value for almost any company. So getting the operating value right is very important in the model. In Modigliani-Miller, the operating value is based on free cash flow. Second point, we talked about how many years we go in forecasting free cash flow year by year before we go into perpetuity. Right. In this case, we're arbitrarily doing 5 years, but note, 5 years of free cash flow value, as staggering it is for this company in present value, 284 billion is 10% of the company. 90% of Nvidia is in perpetuity. And that's common. So somewhere between 70 and 90% of most companies are going to look this way. That's why, and this is what's interesting, is like we spend all this time and effort on this number, okay? Because we're doing individual year by year forecasts of growth rates and margins and tax rates and yada yada and balance sheet ratios. And all that work gets you 10% of the value. The rest of the value, the continuing value, is these 4 numbers. That perpetuity value is critical for any company. Okay. And so that's the point. Like getting those numbers approximately right is really a challenge. And the biggest issue is here, this G, because, and you can start to see it as a what if. Like if I make the G 10% versus 10.7, my share price is almost 20% off with a 0.7% difference in G. So most companies are going to be very sensitive to the G's, which actually makes the paradoxical point. Like perpetuities are easy because they're just 4 numbers. Perpetuities are hard because they're just 4 numbers. And what you put in those 4 numbers is really critical to values and stock prices of any company. And that's the interesting part of this. Like the math is not that hard, but getting the values right, or at least reasonable, is the art form of valuation. And that's what's critical in the process. That's why, because G's are so sensitive, I generally suggest, which is our process in this class, 80, 90% of the time, we kind of forecast the ROIC, solve for the G. That's kind of the way we're setting up the as-is valuation. However, every rule has an exception, right? And you're going to run into a situation where you're going to value a company, you're going to go 5 years, and that ROIC in perpetuity is going to be a little off. And what you're going to have to do is it's going to be hard to figure out the G with an unreasonable perpetuity ROIC that's just arbitrarily your 6. And so what you'd have to do in that situation, ironically, is sometimes you're going to have to put in a G in the model and create the ROIC. Right? That's less common, but it is something that can happen. And maybe next week I'll give you an example of that in class, and I'll have you work on one. But that could happen with your group project companies, particularly if somebody chose an automobile company, it could happen with Ford. So just giving you a heads up on the process that we are doing. Let me undo that. So this is the as is. Our next step is to create 3 more models. Okay. What we're going to do is we're going to call them the bull, the bear, and the target. Right. And the idea is a target share price that Wall Street uses is generally a 12-month share price, right? What do I think the company is going to be worth over the next 12 months, right? Because day to day, stocks can zig and zag. So when you're doing intrinsic value, just as a rule of thumb, they do a 12-month share price. Say, well, long term, it should be worth this. So it should kind of gravitate to its long-term cash flow value. Now, obviously, as new data comes in, that can adjust, but regardless, it's a 12-month target. And so then the question then becomes, okay, before I go to the target, we're going to create the concept of a bull and a bear, a high and a low, best case scenario, worst case scenario. And the idea is using the concept of reasonableness, what could happen, new information that comes out that suggests Nvidia could do better than the current share price. How high could that better look reasonably in the next 12 months, and why would those changes happen? And then we're going to do a bear, which is the opposite. How poorly could things go for Nvidia, and what would that mean reasonably over the next 12 months, and why? And that's going to establish a range. And what we're saying is Nvidia is going to be somewhere in that range, from the low to the high, the bull, the bear. And we're going to create two models establishing the high and the low of the range and the reasons why, which is the more important part of the exercise, right? And then after we do that, we're going to say, okay, where in that range do I think Nvidia is going to end up? That's the target. That's your opinion. Okay. So bull bear, high, low, and the high and the low are not necessarily symmetrical. So for example, it's not just arbitrarily plus or minus 10%. It's not plus or minus 20%. It could be 10% upside, 30% downside. It could be 10% downside, 30% upside. Like it doesn't have to be a symmetrical range when we do the bull and the bear, right? What matters is what could change and why are we changing that for that range, right? And so we do that for two reasons. One, because when we deal with the future, there's uncertainty. So showing ranges, probability scenarios is very important. But number two, if you think about it, if I'm selling research as a sell side to a buy sider who is trying to allocate a portfolio, if you took any portfolio theory at all in your Smith career, the first thing you know to diversify a portfolio is you need the standard deviation of the asset. And so in a way, giving the bull and the bear helps the funds start to understand what that standard deviation could potentially look like in the future. So when they're trying to create their diversified portfolios, they don't just care about a target, the expected return. They also care about the standard deviation. And as I said, the standard deviation doesn't have to be symmetrical, right? And so that's the other key part when we're going through this process. And what's also helpful is to explain why. All right, don't just give me 10% up without saying anything about that. You got to tell me why, what would change to cause it 10% up. So that's the process we're going to start. Let's do the bull. So what I'm going to do is I'm going to take my as is, and I'm now going to save. And I am going to call this, instead of the as is, I'm going to call this the Nvidia bull. Right. Now, it is actually helpful to have done an EIC before we do our bull and our bear, right? Because when you've done the EIC, you've identified Porter 5 today, Porter 5 over time, issues in the industry that could affect the asset that you're evaluating. And when you talked about the change in competitive advantage, you're also affecting potentially the bull and the bear, okay? So going back to the EIC, all right, what are some of the things, whether it was in the 5 forces or whether it was in the competitive advantage, that would suggest an even better scenario for Nvidia? So let's see if you can remember your homework from 2 weeks ago.
At the time, limited competition.
Okay, so if we had limited competition, what financial number might that help? Would that affect growth? Would that affect margin? Would that affect tax rate? Would that affect productivity? Like, what would the impact of that potentially change?
I guess
Maybe margin.
Yeah.
Okay, so if we're talking about margin, we have two choices. We can do a year by year margin, but as I said, it's white cell. We're not really supposed to do this, but let's just say I made this from 61 to 62. Well, guess what? The share price barely budges. In that first 5-year period, a slight change in margin in the DCF, that's part of that 10%, right? What's going to matter is this margin, this perpetuity margin, okay? And right now, to get to the current share price in a perpetuity margin, we are saying their perpetuity EBITDA margin is 67.5%, okay? The highest that it's ever going to be, according to the analysts, is 68. That's in 2026, 2027. So what we're saying is in perpetuity, it's going to have to be higher than that. So we're going to say that they're going to maintain a higher margin for an even longer period of time. Now, putting in a number like 72, that would drive the share price to 130. You can make an argument for it, but generally we know that companies don't regress up into perpetuity. They tend to regress towards the mean in perpetuity. So 72 seems like a tougher number to justify, even in a bull scenario. Okay? So what might they maintain in perpetuity? To be honest with you, maybe 68. Like they actually get back and maintain 68. And so that might be part of my reasonable bull case, or even 68.5, if you argue that they're accelerating their advantage because they can spend even more money and they're dominant player. So the point is, we got to put in reasonable assumptions and we're going to have to explain them. So starting with the next assignment, you're going to be writing 500-word minimum papers. Okay. And you're like, what's going to be in my paper? And what's going to be in the paper is, in my bull scenario, I changed the EBITDA margin to 68.5% for this reason, based on what's going on in the real world. So every time you make a change, you're going to write it up, right? So that's the whole idea. I'm going to turn an Excel model with the changes, and I'm going to explain why I changed what I changed. And I got to link it back to something in the real world that would cause that. Okay. So we're arguing that Nvidia competitive advantage not only is maintained, but actually increases, all right, over the next perpetuity period to get to 68.5. What else could be bullish based on our EIC? What says they're going to do even better than what's expected at the industry level or the company level? All right, somebody in the chat said revenue, which suggests that these growth rates, as good as they are, get a little bit better. Okay. Now, again, I have two choices. I can do year by year growth, or I could talk about really long-term growth. Long-term growth is perpetuity. So instead of 10.7, maybe we'll say 11. Now you might say that doesn't sound like much, but remember there's compounding involved. So 0.2, 0.3% compounded forever, it can actually start to become much more substantial. Okay, because now they're growing at 11% every year as opposed to 10.7% a year. And that, by the way, starts to get me to a share price closer to 135. Okay, and so why might they grow faster? Well, again, we're still in the early innings of AI. I don't think it's going to be gaming that's going to drive their growth rate higher substantially for the size of the company that they're becoming. It's all about AI. And the idea is that, we just said they're dominant in the cloud. Their chips still are the best patent protected chips in the industry. They maintain that advantage for longer periods of time, kind of like the old Intel. And at the same time, artificial intelligence becomes even more important to the economy. And they actually not only sell more chips, but they also sell more software and services around that. And that allows them to grow at a faster rate longer term. Basically, the pie is getting bigger and their share of that pie stays very high. So now they're gonna grow an extra 0.3% a year. You really want to get aggressive, maybe 0.5% a year, 11.2. Right? Now my share price is as high as 144. Okay. Now, I will tell you that we did the as is. These are the three things that are, I told you 80 to 90% of the value is going to be driven by those three numbers. So those are the most important things to talk about. What's going to happen to growth? What's going to happen to EBITDA? Because that's going to drive cash flow. And what's going to happen to the tax rate? So in a bull scenario, the tax cuts for corporations are expected to expire. Right? And depending on who wins the election, will they be renewed? And you can argue in the better scenario for companies that the corporate tax rate stays at 21%. Okay? I know the Republicans have recently said they want to cut it to 18, but in our divided Congress, I think that would be hard to do. But regardless who wins the election, but renewing the tax breaks may be a bullish scenario, regardless of who wins the election. That's a possibility. So we'll put that in our bull scenario. So I'll leave the tax rate at company guidance long term at 17%. I don't think it's going to go up. And I think that's actually the bull scenario. Okay. Bear scenario, tax breaks expire, people pay higher tax rates, and then tax rates go up. I'd actually put that in my bear scenario. Okay. So again, leaving the tax rate alone is part of the bull scenario. I'll be explaining this in my write-up. We're still in the bull. Okay. And so now made 3 assumptions with 3 explanations for all of that. Next question is anything going to change about the balance sheet? Okay. Are they going to change their level of how long it takes people to pay them? Are they going to maintain this level of inventory? Are they going to have to make this level of investment in their net fixed assets? Right. I'm already seeing some improvements, invested capital sales over time on an operating basis going from 0.35 to 0.28. So I don't think it's going to get that much better. So I'm not going to put that in my bull scenario. I think that's actually a reasonably optimistic scenario already. So those would be kind of my major changes that I would make for my bull. And based on that, what I'm going to say is I think Nvidia could be as high as 144 in the next 12 months for these reasons that we just described. That's my bull. Does anybody else want to add to the bull or change anything about the bull?
Can your bull be lower than the current as is?
No. That would defy logic.
For the
Well, because well, rephrase. I'm not saying it's impossible. Anything is possible. But what you're saying is, in the best case scenario, their share price is lower. So you're just saying, how low is it going to go? That you'd be articulating that. So you could argue that. You could say it's overvalued, and even in the best case scenario in 12 months, it will be lower than today. So yes, you could technically say that. Given what we know about Nvidia, you're really an outlier there. But it could happen. So I don't want to be harsh with my comment, but that's what you'd basically be arguing. Alex, did you make that comment? You just had a hand up?
No, I had a hand up for a different thing. Okay. I know we talked about tax rate, and this may just be ignorance on my part about how these are applied. But let's say like subsidies come through to help keep semiconductor and like other manufacturing in America and things like that. Where and how would we apply that to this model, or is that too deep for this class?
No, I mean, it's a reasonable question. So there's a couple of different ways to do that. But remember, what we're really trying to do is eventually model a free cash flow. So in a way, you could argue that subsidies are coming through because the tax rate's not 21%. And the corporate tax rate's 21. So they're already getting some impact of some tax credits or whatever, if they're saying they're going to be 17 going forward. So that's one way that I think they are somewhat modeled in here. The other way that we can model them gets back to, for example, and I don't know the exact terms of the CHIPS Act, but my understanding is Intel's getting like $20 billion to match their investment for their Ohio chip plant. And so what that would mean is that the net fixed asset investment is lower, because if I'm getting matched money from the government, then I don't need to spend 9% on net fixed assets. I might only spend 6% on net fixed assets because the other 2% is coming from the government. And so what I'm modeling is, from my perspective, higher cash flows. So that's another way you might be able to do something like that. Right.
That makes sense. And then we just have to be cautious about the perpetuity, right? Because we're not going to assume subsidies forever. So that might extend our horizon if we look at it that way.
Correct.
Okay.
Yeah. And that's another really, really good point you're bringing up. Is just be cautious when you deal with the perpetuity side of this. Because suddenly, because this is the danger, which when we get to multiples, I'm going to mention one more thing that we're not doing this week to the model is what I call the sanity check, right? And we're going to eventually use multiples as a sanity check on our DCF because you make a small incremental change here, a small incremental change there, and another small incremental change, but the mathematical cumulative effect is actually getting bigger. And then when you compound that forever, suddenly it's gigantic. And then you have this really unreasonable valuation. Right. And that's what I'm saying. Like I can just come up here and I can say, oh, well, 12% versus 11% doesn't sound so unreasonable. But when you do 12% in perpetuity, well, it's going to double the share price. and so you start to see what these revenues start to be. Just click on the income tab. Well, what that means is I'm going to go to, 300 billion by 2030, and then 10% a year after that. It gets really big, really fast. So that perpetuity value gets to be almost 9 trillion before I discount. So I'm just saying it doesn't take much when you compound to really impact the model. So just note of caution for anything that you model when you're dealing with perpetuity. So I think it's a really, really good call out on your part. So let me undo that and I'll leave it 11 too, which I actually think is aggressive because a half a point forever, given their already high growth rate, it is getting even higher. All right, so what I'm saying is I now have 2 markers with these 2 files. First, current share price, 122.59. We always start with the current share price. Then what we're making a case for is what is the upside of Nvidia? The upside of Nvidia is we think it can go as high as 144.11 in the next 12 months. That's our goal, okay? For reasons that we've talked about, which we've written up. Now, and I think the easiest way to do this, save that file. And then close that file. Open up your as is. And then from the as is, create your bear. So back to share. So this is back to the as is. File, save. This is now my bear. Right. So now I'm taking my rose-colored glasses off and I'm putting on my dark sunglasses. Right. I'm viewing the world in a much more negative way. Okay. So what could go wrong with Nvidia over the next 12 months, and how wrong could things go? Right. So reasonably. So back to 5 forces. What could we say could work against them in the market, the industry, or in the competitive advantage? What would you guys say? And why?
Maybe their inventory goes up because people aren't buying.
Okay.
It
So
would be a slight effect, but
well, I think there's 2 parts to your comment. So one, they have more inventory because people aren't buying, but if people aren't buying, what you're suggesting is sales growth is not as high as they expect. And I think that's probably the biggest downside risk for Nvidia is that they have some challenges hitting these sales targets. But before we change that, what else do we have? Zachary?
Well, if a China invasion of Taiwan could impact their supply chain.
So we have China, Taiwan, or even the trade war that's going on between the US and China, which, spills over to other countries, could have an impact, which could slow down growth and or hurt margins. Lucas?
I was gonna say with all the government investment on it could bring new players and get more competition against Nvidia, bring their competitive advantage down.
Which means potentially lower sales and or potentially lower margins because of more competition. All right, reasonable for a bear. Ryan?
Yeah, I was gonna say either more competition or maybe that there could be start to be some substitutes. I heard Apple starting to use some of Google's like other chips now for their phones instead of Nvidia to make their next AI for their phone. So there could be potential maybe substitutes coming out there.
Yeah, so a lot of the premise of these large language models and what we're doing with AI is it's got to be done in the cloud. It's not being done on the device. But Apple and others are starting to make a bet to say more and more they want to process in the device, and if device processing gets more powerful, then the cloud doesn't grow as high. It's not as good for Nvidia because they're not strong in the device. The other thing is, I was watching 60 Minutes on Sunday, and they had a 20-minute segment on quantum computing, and they're getting closer. IBM and Google are getting closer. And, for the next few years, if that starts to become more viable, then that's another big chunk of the growth in Nvidia, because Nvidia is not one of the dominant players right now in quantum computing. Raymond?
I don't know how likely this is, but maybe there's a threat of regulation down the future if they become too big.
You mean they kind of like become too monopolistic and take too much
Yeah.
Is that?
Yeah, maybe the FTC thinks they're too big and is thinking about breaking them up or
and I think that's
decreasing that
reasonable as
growth.
well. That is reasonable as well to think about. Christopher?
When their patents expire, that'll introduce more competition and slow their growth rates.
Yeah, so they're going to always have to kind of push those patents to make sure that they maintain this, and or worry that the government doesn't friend them, or the government doesn't, some governments don't, ignore the patents, particularly in other countries. That could also come into play. So those are potential issues that they're going to have to deal with. By the way, when I say friend, does everybody know what I'm talking about?
I don't.
There's probably a patent attorney in this call that knows more about this than I ever will, but basically, some patents actually have, it's called fair and reasonable something or other. That's what the acronym stands for. And the whole idea is that it's a low cost licensing model. And when you end up in that model, then everybody can basically use your patent as long as they pay that price. And it's a fair and reasonable price, which is not usually as high as some of the companies would want with their patents. And so, for example, a lot of the cell phone technology is under that model. So that, Qualcomm, for example, has a license a lot of their patents, probably at prices lower than they'd like to, but all the cell phone manufacturers can basically use that technology at that price. And so you can't just exploit people with a pure monopoly in a marketplace. The governments will push you if you want to keep that patent to kind of go towards that type of a model. So in any event, so the point is there's several things that you guys have mentioned that we've talked about that could be in this bull case, right? And the question is, what's reasonable in the next 12 months, right? So Taiwan staying a free country, medium term, it's going to be a question mark. Is it going to be happening in the next 12 months? Probably not. So maybe we don't fully put it into our bull, but we kind of keep it in the back of our mind or our bear. What could happen with tax rates? That might change in the next 12 months. So we could think about that. I think the biggest question is going to be growth and margin. And what the question is, how much of what we talked about, for whatever reasons we talked about them, is going to lead to lower growth, lower margin, and what would that downside look like, right? And so what we could argue is, okay, put some context on this. If we have more competition, like their EBITDA margin right now, last year was 57%. So growing into the 60s is pretty aggressive. Like they're getting better over the next 5 years. If that competition pushes them closer to where they are today, and we would expect for most companies to start regressing towards more of a mean, and this number gets down to, let's just call it 60%, which is where they were in 2028, expected to be. Well, then our share price is now 109. Okay. And if tax rates starting in 2026 go back to 21% because they expire and nobody does anything about it, then the share price is down to 104. And if these growth rates, particularly in the out years, not 17%, but maybe starts falling closer to 10, and in perpetuity, instead of 10.7, it falls closer to 9. Right, so they're still growing. They just are getting less of a chunk of the pie because of the competition. Right, they're getting less pricing power because of that, and as a result, the market isn't expanding as fast, and they're not getting that competitive advantage. That's why I'm at 9%, still growing, it's not as fast. Well, now I'm saying Nvidia could get as low as $67 the next 12 months. Okay, it's kind of a grizzly bear scenario for them, but I think it's possible. And so that's my bear. And by the way, what we're really saying here is that there's more downside risk when we play out these two scenarios than upside, right? And intuitively, that's what I feel about Nvidia, meaning I don't think you're going to see Nvidia double in price again. Not in the next 12 months. Now, like it was 250% last year. You're not going to see that happen again. Because when you're a $3 trillion company, going to a $6 trillion company, like you see what the cash flows are going to have to be in this model. And it's going to be harder and harder to justify that. So getting an extra 10% upside is still going to be a challenge for reasons that we talked about. And getting 40% downside, which is what we're really representing here, very, very possible in terms of the scenarios that we talked about. If they start seeing slower growth at lower margins, which are still pretty good margins, then their share price can fall pretty far, pretty fast. So I've established my range. I got 67 on the low end. I got 100 and whatever it was, 40 on the high end. That's my bull and my bear, okay, for reasons that I've explained. And then we go to model number 4. All right, model number 4 is called the target. All right, the target is your opinion. Now you say, where do I think they're going to end up? Thomas?
Yes, can you share the changes you made again one more time?
So what I did, and you're not turning in this file, but if you're following along, the changes that I made were number 1, not in the order that we made them. I said that the tax cuts were going to expire, the Trump tax cuts. So the corporate tax rate goes back up to 20, I think was they expired 28. So I'm raising it to 21, which is right now the corporate tax rate's at 21. So corporate taxes go up. And number 2, we said that the margins were going to go down because of increased competition. And so I put our EBITDA margin closer to the 2028 margin. I called it 60, which is not where they even are today. It's still an improvement over today in perpetuity. Right. I lowered the 1-year growth rate of 2030. Didn't have much of an effect to 10%, but showing the idea that it was going to be slowing growth. Now, I could have actually, even though these are white cells, slowed the growth even further in these individual years. But as I showed you, the 1-year growth rate here is not going to have a big impact. What's really going to have the big impact is my perpetuity growth, which I lowered to 9%. Okay. And I didn't really change any of the balance sheet items because I don't think they're going to make too much of a difference in terms of investment. But I could argue, if you wanted to, that because they're not going to grow as fast, as a percentage of sales, they're going to have to spend more in net fixed assets. Okay, so instead of 8.6%, they're going to spend 10. But notice it's trivial impact on the share price, right? Most of your impact is going to come from these 3 numbers: growth, EBITDA margin, and tax rate. That's where, like I said, the biggest impacts are going to be. And then the G, your long-term G. Okay. Now notice in all this conversation, I'm not changing the WACC. All right. I'm not saying you can't make an argument for WACC, but the idea is that the WACC should represent the risk of the future, and it shouldn't really change long-term future. Now, you could say, things happen that causes, Fed to lower rates dramatically, and so lower cost of capitals for everybody, benefit all the, et cetera. You could make that argument and slightly change the WACC, but most people tend to focus on the cash flows leaving the WACC alone because it's too hard to forecast a year-by-year WACC for a company. It's just too difficult. So we just don't do it. Not usually. Okay. Ryan?
Yeah, when you made the first change, it kind of was actually pretty close to the current Nvidia share price when it was at 103. Do you think the main reason that there was a big, obviously there was a big sell-off from tech in general, but besides that, I think even after it's still been Nvidia has still been kind of steadily decreasing since then. And do you think that's because investors are starting to see the Magnificent Seven numbers and all this CapEx spend with no profitability potential? So they're not AI isn't for everyone kind of thing anymore? it's a very like selective use case kind of thing. So maybe people were like, oh, we over Nvidia too much, or do you think that is like, I mean, I guess I'll see this during the next model. Do you think that's unrealistic or?
What I think is you bring up, and this is why high growth companies are actually not as easy to value, because there's still uncertainty about that growth. And the point is they're eventually going to mature, and how fast they mature, we often become too optimistic. And I think the answer to your question is actually here. So it's not in Nvidia, it's been what's going on with Tesla. And where is Bloomberg? So if you go back and you look at Tesla's share price, and I'll go back 5 years, Tesla share price was as high as $400 a share. Now it's 50% lower. Okay. And they were on a big upswing, just like Nvidia was. And if you had to model Tesla going back to 2020, 2021, what you were going to see is growth as far as the eye could see, with electric vehicle domination of the world. By 2035, we will all abandon our gas-powered engines, and we will then worship at the altar of electric vehicles. Countries will force us to change. Gas stations will go away. We'll all plug in. And you know, that was the forecast. And Tesla might be 20-30% of every new car sold. And they are so far ahead, like Nvidia, no one else can match their technology anytime soon, even the traditional automobile makers. Well, fast forward 4 years, right? Nobody's telling that fairy tale anymore, right? I'm not saying that Tesla isn't expected to grow, right? But competition's here, and it's serious, and it's good. And Tesla is having challenges. Matter of fact, the headline, I know I shouldn't be laughing because this is like gallows humor, but did anybody see the headline of Musk basically told the analysts, like, you should check out our self-driving technology? And one of the sell-side analysts got a Tesla, put it in self-driving mode, and almost killed himself driving because the car was about to wreck in the intersection. He had to take over for the last second. So, and then he put a hold on Tesla, because he's like, the analyst is like, there's no way you're going to do robo taxis in the next few months. Like, your existing cars are dangerous. He's like, I personally experienced this. You told me to go rent a Tesla. I did. And I'm afraid of the car. So I'm saying, like, yeah, self-driving technology is sort of here, but I don't think it's as fast as we thought, because the roads don't support it. The rest of the cars don't support it. The software is not there yet. And it's going to take longer. And I think that was the optimistic view. It's almost like this was the bull, and now we're getting to a more realistic scenario. But even today, there's uncertainty about what the scenario is going to be in the future. And that's the point of Nvidia. Like, I think we might be overshooting Nvidia. As good as it is, things can happen. Right. And we do this in hindsight. But that's why I want to do bulls and our bears. And because to me, like, what happened to Tesla is a cautionary tale for Nvidia and the optimists about AI, because it might take longer to do these things with AI, and there might be more competition. And as a result, if it does, some of these forecasts start looking really, really aggressive, and they got to keep hitting those forecasts to justify the 120 something now, or 112, whatever they are, share price. So that's why, personally, transparently, I owned Nvidia for the upside. I sold it all. I think I actually own half a share. It's because I want to track it. But I sold it all because I was like, I don't think it's going to double again. I think there's more downside risk than upside, and I got out. Now, could I lose 10% on the upside? Sure. But I'd rather not take a 40% downside risk, which is what we talked about in our bear. And I don't think anything we said in this call was unreasonable. And so if they have a Tesla-like moment where they start pulling back, it's going to go down pretty far, pretty fast. And I think that's what's happening with the Magnificent Seven.
Yeah.
I mean, that was, for I don't know, 6 month period of time, Mark Zuckerberg was talking about the virtual universe and how we were all going to buy these virtual real estate with real dollars, and they were going to dominate that. Nobody's talking about that anymore. Augmented reality was going to be the next big thing. Google Glass didn't work out. I don't think Apple can give away their Vision Pros. Nobody wants them.
Yeah.
So I'm not saying artificial intelligence is going to be the next big thing, but And maybe it'll be even bigger. It could. But as I said, that's what we have to kind of figure out. There's a lot of uncertainty here. And that's what we're representing in the range. So the other thing we're representing in our bull and our bear is there's a big range. Like if we were to do this, and you're going to do this for your next week assignment for Costco, I don't think you're going to get 10% up, 40% down with Costco. Right, you could, but I'd be curious to tell me what story you think that Costco is going to melt down. And no, people are just going to stop going to Costco in the next 5 years. Like I don't see that one happen.
Okay, thank you. That's a nice complete answer for.
And unfortunately, that's what, it also goes back to the answer is a question because we're talking about the future. And to me, that's the fun part of this. So we have to reasonably forecast a future. That's the art of the valuation. The math's not that hard. Yeah, you put together the models, you got to learn Excel. It's all algebra. There's no calculus in this class. Anyways, I'll stop riffing.
Thank you.
Comments. Studying this. Concerns, crippling fears. All right, so let's go back to, and by the way, if I go back to Nvidia, not that we would use, like, copy the homework of other people to see what they did, but if we were looking at the real world analysts for their targets, the average target share price today is 140. Okay, which by the way is the top of our bull range. And here's a guy, Citi, who came out today and said 150. Right. Matter of fact, here's a guy from a firm I've never heard of that says 180. So there's some optimists here. But if you look at some of these prices, here's 105. Here's 135. Here's 200. It's crazy. Here's 100. 90, 65, 95, 88, 50, 58, 56. All right. So there are some Chinese firms over here who are Asian firms. I don't know if they're Chinese or not, but they really are kind of bearish on Nvidia. Right. But I'm saying there's scenarios out there where some people are extraordinarily optimistic, far more optimistic than we were. And these are the targets. By the way, these aren't even the bulls and the bears. Spencer?
So with those bearishes, like how often, I mean, I find it very unrealistic. Like the guy just made it 150 today. Like I thought our bear thing was rosy.
So this is his history of Nvidia. So a year ago, in early 23, he was target share price of 21. This is Citi, by the way, raised 24, 30, 42, 52. He was playing catch up, as you kind of see on this graph, with Nvidia's stock price. And then 103, 126, and then went to 150 as of June 26, reaffirmed today. Kind of riding the stock price up. Because in a way, they're playing catch up. I mean, the market, as I said, you can kind of go back 2 years ago with Nvidia. Nobody had figured out how big AI was starting to get. And anybody that tells you they were is lying.
So I guess my question.
Even Nvidia didn't know how big it was going to get. But regardless, sorry, what was the question again? Did I get it wrong?
I guess my question is this guy just not good at picking Nvidia stock because he's so far behind. It looks like he's just completely trailing the whole time. And how he's behind it.
Now he's jumping ahead.
Yeah.
So he's like, I'm not going to be wrong again. I'm going to get ahead of this upswing. Momentum. But I'm telling you, ever since he did that, what happened to Nvidia's stock price? It went from 130 something to 110 something. So Nvidia's now in the downswing as he went up. And again, that's zigging and zagging over a few weeks. And this is a 12-month target share price. But the point is, I'd be curious to see what his rationale is here. What has to come true to get to this price? Right here, you have to read his research report. All right, we don't have access to the Citi research reports, not through Bloomberg. Got to pay for that. But I'd be interested in reading what he says, because that's the other thing. When you give your research to a fund who's buying it, they're not just going to look at your math. They're going to look at your, like, what was behind the math? What were the assumptions? Do I believe your assumptions? And if you start talking crazy talk, then they're not going to pay attention to your math. And this class, I'm not going to give you a good grade. Crazy talk is not acceptable.
Yeah, I just have one quick question. So do analysts never put things in decimals? Do they always have to give round numbers? And it seems like even general, they always do like 105. I mean, I see like a 126 and one a 3, but normally it's usually I see like 105, 110. Like, is there a reason they keep it nice and round and whole like that, or?
I think it's more just because when you're dealing with a long-term future target with a level of 3 decimal specificity, people are going to question that as well. But I don't know. It's probably more convention than anything else. They just round.
Yeah. Okay.
But now it also depends on the share price. Like if share price is $1, then you don't just round the 2. Like then it would really matter. But when the share price gets as high, like 165 and 157.83, I don't think anybody's gonna, argue too much about 17 cents.
Yeah, that's fine.
All right. So back to our final model for tonight, for this part of the class. Finish up Nvidia. So I'm going to go back to close the bear. Let me save it. All right, let's go back. Close the bear. Save. There it goes. And then I'm going to go back to my as is. Which I will share. And now I'm working on the target. So file, save as, target. This is my 4th Excel model. And now I'm going to talk about, all right, what do I think is going to happen? And the answer needs to be between the bull and the bear. You can't have a target outside your bull and your bear range. That wouldn't make any sense. Right? So you have to have it between your bull and your bear. So it's like, where do I think it's valued? Now you can make an argument that the market's got it right. The share price is what it is today. And I agree with every assumption in here. I think it's kind of a cop out, but you can do that. Right? I don't think that's actually my opinion on Nvidia. My opinion on Nvidia is that what I think we're going to start to see is regression of the mean. So we're going to start to see a growth rate, like I said, close to the bear. It's going to start coming down. I think the margins are going to start coming down. Maybe 62% in perpetuity, not as bearish as the bear. And let's assume that we're kind of used to having the lower tax rates in this country. So we agree to have lower tax rates for corporations going forward. And that this growth maybe slows down to 10% for reasons that we talked about. AI doesn't get as big as fast. Competition's a little bit stronger. Nvidia's under that threat, which reduces their margins. And that leads to a share price of 90. That's actually my opinion. I think that Nvidia actually will go down over the next 12 months. It got a little overheated, right? Now, again, they might report a quarter where they like blow their earnings, and their revenue estimates and exceed them by like 10%, and the world goes crazy. But I think it's going to be harder and harder to do as these numbers get bigger and bigger, particularly as companies like Google and Amazon and Meta have also had to justify the level of spending that they're doing, and they're increasingly having trouble monetizing it. So if they pull back on some of that spending, that's going to pull back on Nvidia sales. Not saying they don't grow, but how fast are they going to grow? And they're going to keep spending, $100 billion between them a year. And if they cut that back, that could slow down Nvidia's growth. So long story short, my personal opinion is closer to 90. And then you write your buy, sell, hold. And the buy, sell, hold is pretty simple. If the current share price or the model share price is within 10% of the current share price, plus or minus, that's called a hold. Okay. So $12.26 up or down from 122 is the hold. If my target's in that range, it's called a hold. If I'm more than 1226 above that, it's called a buy. And if I'm more than 1226 below that, it's called a sell. Since I'm more than 1226 below the 122.59 current share price, my opinion would be a sell on Nvidia. That's the buy, sell, hold. Now we will finish with the buy, sell, hold. When you group your group projects in a few weeks, you're going to start with the buy, sell, hold. I'm doing a buy, sell, hold on this company, and let me talk about the analysis. Here's my EIC, here's my historical, here's my DCF, here's my multiples. Questions about anything we've done for the last hour? All right, so I'm going to pause the recording, 10-minute break, and when we come back, I am going to show you, save my target, how to, and I'm not giving you any of these files, by the way, so you have to create these files, okay? So back to, before we come back from the break, in Elms, under Files, under the week 4 folder, there is a folder I put in here called In Class. Okay. In Class is data for Walmart that I pulled today. Okay. So when we come back, we're going to do, and I'm going to put you into small teams, and you're going to do a full valuation of Walmart using the process that we just went through and the model that you built. So over the next 10 minutes, you might want to grab this data and download it. Okay. So I'll see everybody in 10 minutes on the other side. Travis?
Yeah, just real quick. I was looking at Walmart and Costco. They both are missing the information for 2029. I was wondering if that will be an issue in our model as they stand. Are you going to give us that information?
Let me, during the break, I'll upload that extra year.
Thank you. I think it's 2028 for Costco, 2029 for Walmart.
Yeah, you got 4 years. I need to show you the 5th year. Thanks for pointing that out.
Thank you very much.
All right. All right. Resume the recording. We're back from break. While we were on break, I also put up an additional folder. In the week 4 files folder called Target, right? So, and I put the corresponding data for Target in that folder. So what I thought we would do is I will very deliberately show you how to take the model we just built for Nvidia and update it to do the as is for Target. Once we do that, I'm going to break you into teams of 2 or 3 people and then let you practice doing that for Walmart. And then your homework assignment is to do that in the write-up for Costco. So we're just going to do lots of practice here, all right? But what I want to show you is how to update the reusable model first, now that we've built the model and got it all set. All right, so that's the plan. Again, questions about anything before we go through the plan? Because I'm going to be jumping around a lot, it might be a better idea if I share my desktop. All right, so I am going to be using the data for Target, which is in the files folder, to take our NVIDIA model and update it, which means what we're going to do is we're going to start with the NVIDIA as is. What? So file, save as, and instead of the NVIDIA as is, I'm going to call this the target as is. All right. So remember, right now this has the NVIDIA data, right? And where this data is primarily coming from is this raw data feed from Bloomberg, 6 years of bigger historical income statement, balance sheets, cash flows. Okay. So I have done an export, and the exported file just getting in my way. Try it this way. Downloads. Oh, here it is. All right. I'm going to give you a file, and I'm going to call it company or ticker, so TGT data. That file, which I just exported, is 6 years of the most recent historical data for, in this case, Target. Okay. That matches this worksheet. Okay. So what we're going to do is we're going to take this data file for Target, select it in the upper left-hand corner, hold worksheet. We're going to copy it. We're then going to go back to our previously NVIDIA model, now our target model. We're going to select this whole first tab here. We're going to right click, paste special values. Okay. Don't copy paste. If you copy and paste across worksheets, Excel might link back to that worksheet, and that link will always be there. And every time you open the file, it'll be like, where's the data file? So if you just want to move data across spreadsheets, copy it, paste special values. But what I want to do is row for row, cell for cell, copy, paste special, all those values. So the easiest way is select the whole tab, copy it, select the whole tab here, paste special values. This is now the target data. That's step one. Okay. Now you can see here, retailers have weird fiscal years. Their fiscal 24 ended February 3rd. They're now in fiscal 25, right? But they've now reported 2024. So I need to go to my assumptions. Last reported year should be 2024. Now, NVIDIA's also got a weird fiscal year, so they were already reporting 2024. They're at 25. So I don't have to change that, but change the last reported year. Okay. Then I need to update the data. This is NVIDIA's WACC. I need Target's WACC. So screenshot, Target WACC today, 9.1%. So I put in 9.1%. Okay. For G, I don't think Target's going to have a 10.7% G, but as a placeholder, just so I don't get some really weird numbers, I'm going to go back to 3%. This is a starting point. We'll adjust that later. That's kind of growing with the economy. Share count. This is NVIDIA share count, 24.6 billion shares. So basically, Target has DES, screenshot, right here, shares outstanding, 462.6 million. That's the current share count for Target, 462.6. So 462.6. Their current share price, which we're using the DES screen, closed today at 147.90, right there. So 147.90. Okay. Just make sure, was that 147.90? Some reason it got scrunched at the top. 147.95. Hey, the screenshot does that. 147.95. Okay. Next, this is the EEO data, revenue forecast, EBITDA forecast from consensus for NVIDIA. I need to put that in for Target. Okay. So I gave you two screenshots, EEO, which are the first 4 years. And I did one EEO2, which adds year number 5 right there. Okay. Now I'm just going to pull them from Bloomberg. Same screenshot I just took, just make it a little bit easier for myself. So EEO, starting out with revenue for the next 5 years, starting year one, 105,894. So 105,894. Year two, 109,936. 10936. Year 3, 113,898. 13898. Year 4, 118,057. And year 5, is 122,349. Year 5 EBITDA 10,614. Seems so trivial compared to Nvidia. Just a zero here. 10,614. Year 4 is 10,065. Year 3 is 96,87. $92.71. For 2025, EBITDA 86.58. Next, EV to revenue, EV to EBIT year, forward year 2 and 3. So down here, you can always just count the columns. Forward year 1, forward year 2, forward year 3. This is 2 and 3. This is what we're using. EV to revenue, 0.77 and 0.74. Year 2 EBIT, EV to EBIT is 13.12. And 12.43. All right, now we'll go to ratios. Just remember, we are dealing with the as is for Nvidia, which means this EBITDA margin spikes to 67.5% in perpetuity. Okay, because that's what we had for Nvidia. So that number is going to be carried over into this model. Now you can see based on the EEO, it should be 8 point something percent. Okay, so the perpetuity EBITDA margin, oh, I forgot, 0.74 and that number 12.43. Seven four. Oh, why is that not a formula anymore? That's why you got to be careful about these white cells. All right, somewhere around 5.9 to 6%. Overwrite it by mistake. So I want this number, 5.9 to 6, to be that number. Okay. So if I want to get it around 6, add 2.6 to that. That's my EBITDA. So we'll call it 8586. Okay. So that's the higher end of the range, 6. Right. Again, tax rate. So I got the growth, 3.6 the out year seems fine. EBITDA, based on the perpetuity, tax rate. I need a tax rate. Now, for most companies, let's see. What I gave you is something called the guidance. Some companies like Walmart, Costco give tax rate guidance. They give revenue guidance. They give margin guidance to help the analysts. Some companies like Target do not. So Target does not give guidance on tax rate, okay, for whatever reason. Doesn't mean that the analysts don't have to figure this out. It's just the company's not helping them with the tax rate. Okay. So what do? The easiest way, because the analysts are trying to figure this out, is I have given you a JP Morgan analyst report and in the analyst report for JP Morgan, which we have access to, they're trying to do what we're doing, and they have some forward ratios down here in the key metrics section. And one of their forward metrics is the tax rate. There's a search. Oh, here it is. It's further down. Tax rate. All right. So this is the tax rate JP Morgan is forecasting in the out years. Somewhere between 22 and 22.22 and 22 is their perpetuity year. Okay. So what I'm going to do is I'm going to use the JP Morgan tax rate of 22%. I'll just leave it at 22. I don't think it's going to change that much year by year for target. So this is going to be 22%. Now I could put the actual numbers in year by year. I don't think it's going to make much of a difference, but 22% of perpetuity is the important number, which is column M. Okay. So if we don't get guidance, we're going to use the analyst report where they're forecasting the tax rate, and we'll then use that as our tax rate for the company. So I'm using JP Morgan tax rate, 22%. If I were doing a write-up, I would state that in my write-up. I use JP Morgan tax rate, 22%. Leaving the balance sheet alone because the productivity invested capital sales stays at 0.33 pretty consistently in the future. So I don't think I need to change the balance sheet. And so then the other question is, okay, I have these three numbers that I'm pretty comfortable with. Got my perpetuity margin, all right, not changing the balance sheet. Now, what I really need is I need a reasonable G, okay, because I put in the current WACC, all right? So right now, their share price is 147. The model's 96.53. So the G is obviously higher than 3%. So that's where I'm going to goal seek. So tools, goal seek. I'm going to set in the DCF my valuation of forecasted share price, D30, the valuation tab, to the current share price, which is 147.95. And I'm going to say find that by solving for a G, which is B7. When I hit OK, the answer is 6.1%. So at a 6.1% G and this ROIC, which is based on these margins and productivity, that leads to the 147.95 share price. That save is my target as is. And I went through that relatively quickly. So, Blake?
Yeah, in the assumptions, are we just continuing the assumption that operating cash is just 2% of revenue? Is that just something that we'll just continue to use as our assumption going forward?
For this class, yes, for a simplifying assumption. 2% of revenue is another way of saying 1 week of cash.
Okay.
So I don't think anybody can operate with less than a week of cash. In fact, I think companies generally start to struggle when they have less than a month of cash. So, you know, if nothing else, you could make it higher. And you could argue that companies need more cash by industry, but for our purposes, at least 2%. But it gets back to these assumptions. If you want to change any assumption in this model that's in yellow and you feel it's reasonable, change it. You know, explore. You know, you're modeling things out. Right now, I'm trying to strike a balance, even though it's called the advanced class, between making it so advanced and something that we can actually accomplish in a 6-week period of time. Chris?
You jump back to the goal seek real quick.
Sure. So the idea is when you use Excel as goal seek, what you do is manually. You just keep changing the G until you match the share price. That's the manual way to do it. If you goal seek just says, let Excel do that for me. So what you just do is you set cell that you want to solve for. In this case, the current share price, which is off the valuation tab. That's the D30 off the valuation. Okay. That's what I want to solve for. What value do I want Excel to solve for? The current share price, 147.95. And what do I want Excel to change so that the model and iterate through until it gets to 147.95 and then stop? I want it to change the G, which is B7 on assumptions.
Got it. Thank you.
And then when you hit OK, Excel is going to iterate through. Now, 9 out of 10 times this is going to work. But every now and then you're going to do this and Excel's going to explode and give you some wacky number that makes no sense. Okay. And then you're just going to have to do it by hand or something else. Right. So for example, if you have a negative spread, you can't have a higher and higher G that's going to lead to a higher share price. So something's going to have to give if you're in that situation. But those are some advanced things we'll talk more about next week. Richard?
Yeah, I kind of like just a quick kind of question regarding target. When you see that the perpetuity growth rate is 6% for a company that's kind of been established in technically in an industry that, unless significantly something changes with how consumers purchase things, would it be a fair assumption to someone say at a broad aspect that the entire market's kind of overvalued?
Well, you're leading to your target and you're kind of bull your bear. So the answer is we're going to do a target, a bull, and a bear, and that might be some of the bias that will start to play through as you model this out. But I will tell you, this is their share price today. And so that's the whole point. When you do an as is, what I like to remind people is the as is not whether you agree with it or not. The share price is literally a data point that you're observing. And what we're trying to say is, okay, what cash flows lead to that share price reasonably? Now, when you do that and you say, well, this doesn't look reasonable, then what you're really saying is I'm probably going to model something that says my target is below this. But you still got to model whatever that price is. And that's what we're calling the as is, whether you agree with it, because that was where they closed today. But you're right, a G for a company like Target of 6% for that size company in retail, that does seem somewhat aggressive in a perpetuity. But we didn't do an EIC, and we should understand what the company is talking about. So for example, I also threw in that folder, there's another JP Morgan report where I'll just happen to quickly look at this as you guys went to break. Because I literally grabbed this data during the break. That's what I said. It told you it would take us 10 minutes to do company number 2 after we built the model. But they basically said the analysts did a walk with the Target CEO of a brand new Target store, kind of looking around, talking about what they were going to do to drive all the sales and margin growth. And it was interesting that, it's kind of this back to basics retail 101 mentality of focusing on, the stores, value price, what's in stock, having good execution so they don't run out of stuff, not too much inventory, and also having, more relevant stuff that people want to buy. So better margins, yada, yada. So that's kind of they're talking up the analysts about why they're going to grow faster and get better margins. And then the analysts are down here saying, yeah, but consumers getting softer. The margins are probably going to weaken. Event-driven low promotion shopping is becoming more exaggerated. People are going more to the everyday low price model. You're trying to get people to come in here on sales and drive stuff. And I'm not so sure that sounds like it's going to work. So it's a way that as the company's kind of talking up the growth in the margin, the JP Morgan analyst is not buying it. And they're saying you're going to look more like everybody else. So that's why he basically modeled out a whole opinion. That's just one opinion. But, I just was showing you what his target was going to be. You could obviously come up with different ones, but that's why it's helpful to do the EIC along with doing it. I know we don't have time to practice that today with Costco and Walmart. You're welcome to, but at least mechanically, I want you to start working through this process and make some reasonable assumptions. You guys know a little bit about retail.
So it's kind of like it's almost like a C-suite level marketing kind of scheme almost to the analyst. And
you got the CEO talking to the sell-siders directly, walking them through a brand new Target store, trying to convince them why the strategy is going to work with the hope that they buy into it. And JP Morgan is not buying what he's selling. That's what his research report says. You guys can read it. That doesn't mean he's right or wrong, but that's, part of what they're trying to do because they're trying to figure out the future. Wade?
Yeah, could you leave your ratios tab screen on?
just real quick. Thank you.
This came from JP Morgan because the company didn't give guidance. So I used what the JP Morgan rate was. And because it was like 22, 22.2, I was just being lazy and I put in 22 for all the years. I don't think I was meaningfully gonna change the valuation. Like if I made this number 22.2, like I was I gonna add like 80 cents to the share price. So 22. All right. I know we did that relatively quickly, but that's how you basically take and reuse the model to create another as is. Questions? Other questions about what we just did? Okay, now time for the fun. So what we're going to do is, as I said, in Elms, files, week 4, in class, here's all the data from today for Walmart. Very similar to Target. Okay, I want you to do what I just did, plus create 3 more files. The bull, the bear, and the as is, as well, sorry, and the target, as well as the as is. Start with the as is, create the other 3 files. Here's your raw data to do it. I gave you a JP Morgan analyst report. They had to give guidance, but I thought it'd be helpful to see what JP Morgan says about their future. And I gave you what Bloomberg calls BICO, which is this file. What the BICO represents, because you don't have time to do the EIC, is for Walmart. A nice feature of Bloomberg is they curate the analysts. So basically these guys, or a woman and a guy, Jabril and Jennifer, read through all the sell side analyst reports and summarize it right here. So it's kind of like the summary, the cliff notes of the analyst reports. So I gave you that for Walmart, just to kind of help you think through the bull and the bear, and potentially the target. So I am going to stop the video while you guys work in teams. I'm going to be here in the main room if anybody has any questions. And I'm going to give you, what time is it? 8:06. I'm going to give you 40, we'll say 9 o'clock with a break. So that is 50, well, by the time we start, 53 minutes from now, including a break. I'm going to put you into small groups of 3 people. And I want you guys to go through the process to create the files. You're all going to work collaboratively in those groups. You're not turning it in, but we are going to talk about the other side. And this is a replica dry run, with the exception of you're going to do a 500-word paper of your Costco homework assignment for week 5. Questions before I send you out to the breakout rooms? So we got 34 people. That's 11 rooms. And I am going to 53 minutes. So you'll have a timer. All right. So if nothing else, you know where the data is. You got the files. I'll see you guys at 9 o'clock back in the main room. Okay, recording is back on. Welcome back. Hopefully everybody made a lot of progress on Walmart. Do we have somebody who wants to kind of volunteer to walk us through your as is?
I can go.
Okay. So if you want to share your screens, we can all see.
Absolutely. Give me 1 second. Sorry.
That's okay. I have this challenge all the time. Too many.
Okay.
All right.
All right. So, so this is Walmart. This is our as is. Oh, sorry. This is our as is. You can see just going through current price. Yep. That's all.
Sorry. One minor change.
Yep.
Can you go back to model data?
Yes.
Can you look at cell H4?
H4.
So that says last year was 24.
Correct. Yep.
So go to assumptions.
Mhm.
Just to make sure everybody did this. He then had to change B2. I just want to make sure everybody adjusted years accordingly. And that's just a trick you should always do every time you load the file, because different companies are going to have different years and anytime things get updated. So sorry to interrupt you. I just wanted to put that out for everybody.
No, I appreciate that.
But
Okay, so obviously, like we did in class, we kind of left the base assumptions the same, except.
well, let's go back and tell me what you changed. So just so everybody sees, what did you put in?
Yep. So I guess starting on the ratios, we worked on the revenue growth, the EBITDA, and the tax rate. For Walmart, we said that the tax rate was going to be 25. If we look at Bloomberg, it said between 25 and 26. So we saw no reason. Yep. Yeah. So we saw no reason to keep it to change it there. In terms of EBITDA, we used the Bloomberg as well, and we got a range of 4.6 to 4.8. So what we did is we just split the difference and did 4.7.
All right, so hold on. Yep. That's not going to be the EBITDA. That's going to be the EBIT.
Yeah, the operating income, right? That's the EBIT.
So that's going to be cell M9.
M9.
So M9 needs to be 4.7.
Oh, got it. So we have to change this to get to 4.7. Got it.
6.5.
6.5. Yeah.
Sorry about that.
No. That's why I want to go through this for everybody. There's a lot of moving parts here.
Got it. Okay. So, yep. That is my note. Sorry about that. So 6.5, that obviously changes things a little bit here. So let's go back here real fast and do.
Yeah, you're going to get a far different growth rate when you goal seek.
which makes a lot of sense, because I thought that was pretty impossible that they were going to see a 69.67, I think it was, or something.
Yeah, 69.37.
37. Okay, got it.
So real quick, on your two share price screenshots, you had two different share prices.
Correct.
One, I used the 1.9 for ours, and they also had different. The two different screenshots had different what's it called, EV over revenue, or not EV over revenue. Sorry, EV over EBITDA numbers in there as well. So
short version is when you do something in the middle of the day, which is what I did. Literally between the time you take a screenshot and you go to the next screen, the share price is changing in real time. So it's bouncing all over. That's why, just unofficially, it's just for this class, I keep saying use the share price in the DES screenshot on the assignment. Because now when I did, for example, Target, I did it during the break, so the market was closed. So the screenshots are all going to be linked up. But if you actually do, sometimes like I did today, screenshots in the middle of the day, it will dynamically change. And even the multiples will slightly change, because every time the share price changes, all the multiples adjust.
Okay.
That's why it's really important in the real world. Just sync your data. Whatever you do, you should sync your data to make sure you're consistent, because timing differences could actually start to distort things.
Okay. All right, thank you.
Yes, that's a good call out.
So
it looks like you redid a goal seek.
Yep. So we redid the goal seek. It went from 6.9 to 5%, which, in my opinion, is still a little high for a mature company like Walmart.
Yep.
But that's our as is. I don't know if you want us to go through the other ones, or if you want.
Well, let's just pause here. For everyone else, we had 10 other teams. Do you have numbers that look similar to this G? Around 5%. Did everybody get about a 5% G?
Yeah, I got the same thing. I think the only thing that was different is our tax rate was 25.5% for the future. I said 25, but
so that might, and again, because as you look at the guidance, we are dealing with the future. You could look at the final year, you could look at the range, the guidance, 0.5% here or there. There could be some differences.
Yeah, so
slightly
but
different.
pretty much same G though.
Yeah,
it's like 5.04.
But a slightly different G with a slightly different tax rate.
Yeah.
And so, by the way, if you submitted these, I would give both teams credit, or both people credit, because those were reasonable assumptions for the as is.
Okay.
All right, but back to this. Anybody else? Did everybody else get these numbers? Anybody get far different numbers than this? All right, good job. All right, keep going. Do the bull.
Okay. So this is the bull case. So our assumptions here, let me just update this real fast though. Oh no, I mean, that's roughly what we wanted. Okay, so bull case here, you can see that we kept the growth rate at 5%. Again, we didn't want to go too crazy. Where we really adjusted the numbers was the revenue growth rate. We went from 3.9 to 4.2. We basically said that Walmart's recent expansions in terms of opening new stores, online presence, would keep that at a relatively elevated rate. For EBITDA, we put it at 6.6, which ended up getting us to that EBIT margin, which is on the top end of the analyst estimates. The other thing we changed is we reduced the tax forecast to 20%, just assuming that, maybe in the near future, policies might change and Walmart might find a way to reduce their tax rate, which over the last was at around 28%. We think that they could go down to 20%. And with those figures in mind, we arrived at a model price of 79.51, which is 14.63% higher than the current share price. So we recommended a buy on the bull side.
All right, so real quick, did you change the G again?
We kept the G the same.
Okay, so just you got to state that because that's just such a critical ratio. Like even if you leave the G alone in our bull, we're leaving the G alone for this reason.
Got it. Okay.
Or even the balance sheet. Hey, we didn't change anything in the balance sheet. We thought that those are reasonable going forward, just to kind of validate things, even if you're not changing them, why you didn't change them.
Perfect.
Okay.
Thank you.
So why don't you go through your bear then?
Okay. So our bear case, for our bear case, the main driving factor was the value growth, continued value growth. We brought that down to 3.5. We basically said that Walmart can beat GDP growth, but they're a mature company and we don't see them, getting into those higher single-digit numbers that we saw in the first two.
Okay.
The 3.5 is the main driving factor here. Additionally, we kept we reduced, I should say, the revenue growth model, or the growth rate, I should say. We reduced that to 3 from the base, the as is of 3.9.
Okay.
Our reasoning again is similar, just that Walmart, these growth rates aren't going to be typical going to the future. The EBITDA, again, I think I need to change this to get this to, because there was some confusion there. So what was it, 6.6?
Well, the real question is, in your bear scenario, what did you think, or what would you think the EBITDA margin would be? Would it be going down? Would it be?
I think our assumption was that with Walmart's, their EBITDA margin was already relatively stable, and we just assumed that because of Walmart's size, that they were going to be able to, whether that's pushing on suppliers or creating a better store brand or whatever, they were going to be able to hold that margin into the future.
But even with all the inflation we've had in the last couple of years, supply chain disruptions, you're making an implicit assumption that they'll still manage that effectively, even in a bear scenario.
Correct. In this scenario, yes.
Okay. Seems like that's optimistic, but okay. I'm not disputing, just stating what you're telling me.
Okay, so then the other thing that we changed was the tax rate. We said that, let's say a new administration comes in, they push for higher tax rates, the minimum of 28 or something. So we brought that up to 28. That did not affect the share price nearly as much as the growth rate did, but we still wanted to take that into account.
Okay.
And then just to go through this, it was a 32.9% change from the current share price, and so we recommended a sell
Well, no, this is the bear. This is not your target.
Okay, yeah, sorry. That's coming up. I got ahead of myself.
So before you go though, so just a summary, what you're really saying is the downside risk to Walmart from your perspective is lower growth and slightly higher taxes. That you think even in a downside scenario, they're going to maintain their margins. And you could elaborate a little bit about that in the paper.
Correct. Yep.
Okay.
And I guess in that case, would you recommend talking about was that a valid reason that I gave in terms of Walmart, because of Walmart's size, they're able to pull various levers, whether that's SG&A or their margins.
Walmart is, historically known competitive advantage for leveraging that size in the supply chain to squeeze suppliers. And they've been very effective at doing that over the years. And what you're just saying is that's been a source of their advantage, and they're going to continue to do that. And so you don't see a lot of downside risk in the margin. Now, whether that's right or not, we're dealing with the future, but I think it's not an unreasonable way of explaining what you're doing. But I guess that's the whole point. Like, I don't want this to just become a plug and chug exercise where you just change a few numbers and submit an Excel file. Like, there should be at least some thinking around what you're changing a number to and why you might change that, why that might be a reasonable change. Like, I think that's, and that takes practice, by the way, because in the knowledge of the industry. But so since we don't have too much time for that, at least some, biased knowledge of an industry.
Right. And then one thing that we should not do, and correct me if I'm wrong, is refer to historical data saying that Walmart's historical EBITDA is XYZ average, and that's why we think it'll continue. That's incorrect, correct?
No, that could be correct.
Okay.
You can absolutely say that, they are going to return back to their historical margins.
Okay.
And that's not, but again, why? The key that makes it correct or incorrect is the why. Because if you just say it's just going to be the last 5-year average, like that doesn't really tell me like why you're using that number. And that to me would be a deduction. But if you just said it was going to return to historical reasons for yada, 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 and it made sense, then it's like, okay, that's a reasonable assumption.
Okay. Perfect. Thank you.
All right. So just real quick, what's your target?
Yep. So target is, and I summarized it here. So target is 3273. Again, this basically is what the as is was. This needs to be raised because again, I made that mistake here. But then the growth assumption was the 5%. So originally was 6.9, and we changed it to 5.
Okay, so where did you put your target price?
Oh, right here. Sorry.
So that's 32, but that's not the right price because you got a problem with your EBITDA margin.
Correct. Yep. So if I change this
back
back
to something.
Yep. So 6.5 goes to 6. That, and then yeah, in the interest of saving time, I might need to reevaluate with that change, but
you might be essentially an approximate hold.
Yeah. Okay. Yep.
Because your target's pretty close to the current price. So you kind of think that the market's kind of got Walmart right today. Is another way of saying.
Right. At least with that assumption. And again, I think if I had more time to fix that error with the EBIT margin, I would.
I didn't give a lot of time, and like I said, I think with the one exception of misconstruing which EBITDA versus EBIT, which is easy to do.
Yeah.
Good job walking through it. And by the way, I like your little table.
Oh, cool.
There, because it's very clear. Your upside downside. Because what you're saying is you believe because of growth that there's more downside risk to Walmart, and that's going to be the key driver there. So great job.
Perfect. Thank you very much.
And so, ultimately, if you turn this in as an assignment, you would get a good grade. With the one exception of that one mistake that you corrected.
Yep.
All right.
Thank you.
Let's have somebody else go through. Let's see how somebody else did the same thing. So who wants to follow that?
I can jump in.
Great.
All right.
So why don't you, same thing, walk us through the 4 and what you changed and why you changed it.
Okay. So we had a very similar assumptions as the last group. We ultimately ended up with a growth rate of 4.34, with our ratio matching roughly
That says 4.93.
4.93.
Sorry.
Must have read another number while I was talking.
That's
Let's see if we get this exact on the fly. What did I scroll special? Get this to 69.365. Let's grab our correct colon. There we go. Great. All right.
Yeah, still 4.93.
Yeah, so slightly different. But incredibly similar assumptions. Obviously, this is pulled from our screenshots. I have little notes next to here showing exactly where we got them. We think that, so there's not much to be said in terms of assumptions. A lot of this is driven by exactly what we saw in the screenshots from Bloomberg when it comes to the as-is. The 4.93% growth seemed reasonable, especially for such a large company. They've been well established. There's a chance that they could grow at 5%. It's likely a little bit less than that. But you know, that's something we can get into in our targets.
Yeah. Like I said, back to the as is, this is going back to, you know, not the commentary on good or bad.
Okay.
You can start framing that for your future analysis because it is what it is. So that's the point. Like the market's using an approximate 5% growth rate for Walmart today.
Yes. Which is what we got.
That's actually the first part. Then you can get into the other models, you know,
Okay.
whether that's a reasonable one or not. But when you do your as is, it's almost just like, all right, I'm just trying to explain what I see mathematically. And this is what I had to do it.
All right. Is there anything specific you want me to get into in terms of articulating mathematically?
All good.
Okay.
So why don't you go through your bull, your bear?
So in our bull analysis, we made a couple of assumptions associated with EBITDA and, you know, specifically margin and growth. We referenced the Federal Reserve rate hikes actually having an impact on inflation in the near term and on into the forecasted years, which strengthen the consumer spending power, which allows us to pull in more growth, and it has a positive impact on EBITDA. Yeah, and then so that flows into the growth and EBITDA values that we decided here. We try to be reasonably conservative with the impact. We have a note, a disclaimer up at the top that, you know, based on historical trends, the organization hasn't varied drastically from its status quo in the growth periods and in the contractual periods. So our assumptions were meant to be relatively conservative. So we have a slightly higher, you know, about 50 basis points higher than the as-is growth rate, and then slightly higher EBITDA margin for in terms of profitability.
Okay. But by the way, the first team kind of talked a little bit about Walmart's leveraging their supply chain power. You didn't really say anything about changing competitive advantage or what's going on in their position in the marketplace when you talked about the growth in EBITDA. Would that have any influence in the increase in EBITDA in the full scenario?
Yeah, it does, and I think we just forgot to add a note actually, because in our bear analysis, we actually favor the supplier in this scenario, and we think in reality, I think we actually mentioned this in our targets, that Walmart, being such a major player in the industry, has a reasonable amount of power over its suppliers, and considering that suppliers typically bid to be able to be placed in Walmart and get good placement in Walmart. So I guess we could have integrated that into the bull analysis in hindsight. And that definitely would have driven margin.
Well, what I'll say that before you go further, and you guys can all think about this when you start getting to your final presentations in a few weeks, because you're gonna have to do this on the companies that you selected. Like what you did here, as you put into PowerPoint would be helpful, because I like this is what we changed, the deltas. And so it's
Yeah.
really clear what you changed in your model, and it's really clear what assumptions you used. So, even if you took screenshots of something like this and put it into the PowerPoint, that would be helpful as you go across the models or summarize that. So I think that's a good addition to what you guys went through.
Sure, and I think the other group did a good job of comparing to prior, setting up a little chart, but here we see that we're
The 4-box table, that was nice as well.
yeah.
Yeah.
But here we get it, obviously, in the whole scenario, we get a share price of 98 as opposed to the original share price of 60.
Okay. And then where was your target?
Our target, I haven't gotten into the bear scenario.
Oh, sorry. Yeah, go the bear.
All right. So in the bear scenario, we mentioned, the political climate and their potential suppliers' power strengthening as global unrest limits sourcing options for Walmart. And in general disrupts the supply chain, which negatively impacts Walmart in a similar fashion. So we had an increase in taxes. Actually, we may have forgotten to put the note here, but the increase in taxes is associated with a more liberal leaning win in the upcoming election. Their intended increase in corporate taxes obviously impacts it. I should label this orange like the others. Impacts taxes, increases it from 25.5 to 35%, which has a major impact on the share price. And then some opposite effects in terms of growth and margin associated with that supply chain.
Okay. The only thing I would just suggest is when you first went through your assumption, you talked about that first changing growth, revenue, bullish, etc. If you then directly link to, and therefore we changed this in the model's value.
Okay.
So don't just, this is for everybody, don't just list a bunch of assumptions and then separate out that from your mathematical changes. Connect those dots as you're going through.
Yeah, definitely. And I'm thinking in terms of our paper too, probably would be a good idea.
Yeah. So this assumption led to that change. And that assumption caused me to change this. Like, I think that would be more helpful as you guys are all going through this.
All right, so moving on to our target. We grabbed a little bit of what we believe to be more likely in our bull scenario, and then some of what we thought was more likely in our bear scenario. Again, the rates of change are limited based on historical trends. They are, relatively steady over time, whether they are contracting or expanding. We say that the Federal Reserve rate hikes could potentially reduce inflation, but that'll actually have a negative effect as consumers move away from Walmart's cost-based business model towards higher-end brands. We were talking about people who could have got priced out of Target during high inflation and low consumer power can now return back to that kind of brand as opposed to shopping at Walmart. Then Walmart's, we referenced, as you alluded to earlier, that Walmart's power over suppliers is strong and allows them to offset the impacts of the shrinking consumer base. Also, gives them power over their suppliers in terms of mitigating. It's like if there's a reduction in one area, they can squeeze a little bit more out of their suppliers to offset the impact. And then we referenced the recent assassination attempt on Trump, potentially increasing his chances of winning, which implies a reduction in corporate taxes in this case, as opposed to our bear scenario. So, and his proposed tax cuts are down to as low as 18%.
All right, so what was the final price and how did that compare to the buy sell hold?
The final price is 93.58, which is not far off from our bear scenario. I mean, excuse me, bull scenario, which is 98.18. So we're about $5 per share off from our target.
Comparing it to the current for the buy sell hold.
Sure, the current is 69, so we assume that this is a buy.
Okay.
Yeah, so here's our current price as reported in the screenshots. I can zoom in there if it's too small for everybody.
Got it.
So this is our suggestion is a buy.
All right.
There's a lot predicated on the political outcome of the elections.
But notice how tax rates do impact share prices. And that will have a big impact not only on Walmart, but companies in general. All right, two different points of view with where Walmart ends up. Both could be right. And so back to process. That's what's important here is kind of following a process, explaining your assumptions, connecting the dots. Let's do one more team. Preferably somebody of the female persuasion this time. I'm calling somebody. We don't want to have a volunteer.
My group went already.
Your team went already?
Yes.
Okay, then you're safe. You have immunity.
I would say mine did too. Travis was on my team.
Okay. So Sarah, Claire?
We had some model issues in our groups. We didn't get this far. I'm sorry.
Who was that? Who had the model issues?
That was Sarah Hansen.
Yes, Claire.
And
Okay.
Raymond was in my group as well.
How about Claire then? We're running out of elimination here, Claire.
Yeah, I know.
Volunteered because no one else wants to go.
But I'm gonna be really bad at explaining this.
That's
That's why I
okay.
didn't
That's why we're practicing
volunteer.
today rather than complaining about your poor grade and your homework assignment. Like,
Oh
now's the time to get
no.
it out there.
Oh no. Oh, not foreshadowing. Jeez. All right, let me pull up the
I want everyone to do well.
I'm
Now's
pulling
the
up.
time to find out what challenges we may be having.
Have to log in with Duo Security. Just one moment, please.
All right, but nonetheless, as she's getting ready to do that, hopefully this is giving her a flavor of what you're going to have to be doing for Costco, which is your assignment with a write-up. And then, as I said, I'm a little behind, but I'll be starting to put your data up there for the companies that you chose. And then you guys can start using these models to start your valuation of those companies as well, which is going to be a PowerPoint, 20-minute part of a 20-minute PowerPoint presentation in a few weeks.
Okay.
But by the way,
Yes,
Claire,
okay.
just in advance, thank you. So,
Oh, of course. Anytime. And by anytime I mean maybe not. Okay. Okay. So are we forgive me. Starting with as is.
start with the as is.
Claire, do you want me to share our
Yeah,
as
can you
is?
share your
Sorry,
screen, please?
we built one and I shared links, so I can share the screen and Claire, you can walk through it and I can
Hey,
jump
there's
in
no
if
I
needed.
in team, so there's exactly.
We can surely make an attempt.
Let's go team.
Woohoo. Okay, great. So these are our numbers that we got, our 5.14 growth. We did that yeah, goal seek. Getting to a current share price, or we already had current share price. And so
Seems like the big one on the as is what did you guys choose for the tax rate?
we had it at 25.5.
Okay. From the guide.
And I think yes, from the Bloomberg screenshots, the guidance on Bloomberg screenshot. Yep.
Okay. All right. So I think these are pretty consistent amongst all the teams, obviously. So why don't you start? Give me your bull, your bear.
Sure.
You want to take those, Claire, so you know where you're clicking to, or you want me to pull them back up as well?
I got it. I got the other three. You guys
I was a
have
bad team member,
this.
didn't share the as is, so that one's on me.
Oh, that's okay. That's okay. All right. We are in the bull sheet now. So we also have a Google Doc with it. So we shifted tax rate to 21% because what did we say? Because Walmart is already paying over the corporate tax rate. We just kind of assumed that they would continue to do that, even if it drops to 18%, I believe was the proposal. We also reviewed the documents and saw that automation improvements could potentially positively affect the stock price, even if it's just a couple tenths of a percent on the G. So we upped that to 5.3 rather than 5.14. And
So
also
be
reviewed
explicit.
that.
So you're saying that the automation is driving faster growth.
Yes, correct.
Just be more explicit when you say that.
The automation is driving future growth,
Well,
as well as
you said we read about automation and then we changed growth. So just a couple words connected.
Got it. Additionally, we reviewed that same store sales and the accompanying or the parallel e-commerce growth also has potential to increase future growth and future revenue. And we had set the revenue growth rate perpetuity at 4.2% in reflection of that.
So that's that's actually going to be in the assumptions, the G. So that's also the 4.2. Because that's the perpetuity growth. 2030 is just the beginning of the perpetuity period. It's just a 1 year growth rate. The one that's the real perpetuity growth is in the assumptions. That's the CVG, B7. Which right now you have
Sure.
at 5.3.
Right. Alex, maybe you want to jump in on that, Chris?
Yeah, to that point, Claire's reasoning was what we talked about as a group around seeing some growth in things like automation, e-commerce, and gaining efficiency, helping to drive some of that growth in perpetuity. This is our bull case, yeah, as well as Claire, I think you touched a little bit on potentially seeing some growth in EBITDA as well due to that, because automation and other things could drive costs down, therefore raising EBITDA, both generating a higher the share price than what we're seeing today of roughly about 80%, or excuse me, $80. We were definitely on the conservative side with things, similar rationales. I think Logan, it was for the first group, knowing that Walmart's a well-established organization, but definitely still saw some opportunities for them to continue to grow and expand, especially in the e-commerce and like automation areas that could help continue the growth above, I think, some of the like 3% numbers we saw in some other models.
Okay. Good. You guys want to do the bear? And since you're a team, you're welcome to do it together.
That would be so fabulous if Alex and Chris could jump in and help me out a little bit here.
Sure, I can, Claire, if you want me to.
Thank you.
Yeah, I can talk through it really quickly. So similar, well, I guess the opposite side of the coin for the bear, one of our big assumptions was around folks like Amazon, as well as we heard mention things like Target and maybe some of the other massive grocery stores starting to eat into Walmart's market share, especially in grocery, which was referenced a few times in some of the materials we received, which would drop that perpetuity or the revenue growth rate here down to 3.5%, as well as on our assumptions tab, we dropped the growth perpetuity rate as well to denote that decreasing market share. And then additionally, we talked through some of the concerns with like rising prices, and inflation and other things, again, hurting our EBITDA there in 2030. So we decrease that versus the last model as well. Then I think the last big piece, and Claire, Chris, let me know if I'm missing any big ones, was around the tax rate. We took a bearish look here and saw that if potentially some of the corporate tax rate increases as the current administration and potential future administration are talking about, that would also impact Walmart's tax rate. So we saw that going up to roughly 28%, all of which led to a bearish price of about $57. So I think our range was between about 57 and roughly 81 as we move towards our target.
Okay, great, keep going.
And then I guess I'm on a roll by that look, Claire, so I'll keep going.
You're doing a great job, team.
Appreciate it. So the top line or the recommendation first, we recommended a hold here. We got a model share price of about $74, and that was based on a few key assumptions. One, we thought that revenue growth would remain relatively flat compared to 2029. So in 2030, we have it growing about 4% perpetuity, which matches with our forecast as well as historical data, and was based on Walmart's both established brand and reaching into other places like e-commerce, as well as encouraging numbers from their same store sales growth that we saw in some of the materials. So they're just becoming more efficient with what they're selling out of the same stores. And then similarly to the automation point we brought up previously, we see that having a large impact on their EBITDA in the future, especially because some of the numbers cited, we're talking about almost 50 or 55% of their fulfillment in FY26 starting to be through automated services, especially for online deliveries. So we see a mutually beneficial relationship there, that if online growth happens and automation happens, you're going to see costs go down and EBITDA increase. And then we took a conservative, very definitive, we think taxes will stay roughly the same because we don't know the political outcomes right now. And that's a update that can be easily made in the model later. So we wanted to remain conservative with some of that estimation. So across those three main areas, I think we kept the G very close to what it is today. I think it's about 5.2. So some slight increases based on some of the potentially encouraging assumptions we made around growth for Walmart, all of which culminates in that hold recommendation we started off with, and a target price of about $75 or $74.26.
Yes. Good job. So, like, well done, your team and all the teams, by the way. So, and again, slightly different numbers, and that's okay. Just as long as we're kind of connecting the dots, tying the rationale, kind of following the process. So, questions about what you just did? Jonathan?
Yeah, I have a quick question. In terms of buy, sell, and hold, you had mentioned earlier, was it a 12.26? Is that a percent difference that drives by, or did I imagine that number? Or was that specific to this example, like $12 in any direction?
It's plus or minus 10%.
10%, okay.
Plus or minus 10%. It's not a dollar amounts percentage.
Okay, cool.
Within 10%,
and then
it's considered a hold.
Gotcha. And then did you just say on the last example, on the assumptions tab, the CVG, does that override the growth rate for 2030 on the ratios tab, or can those two be different figures?
They're different figures. And that's what I was trying to point out when Claire said that. And it was just, it's easy to, because there's a lot of stuff, moving parts. But the 2030 number is just a 1-year number. Now it's the beginning of the perpetuity period, but the perpetuity growth rate is going to be on the assumptions tab. The 2030 number is just literally that 1 year. And they can be different, which they were.
Got it. All right. Thank you for clarifying.
So that's why when you guys talk perpetuity, it's easy to say, oh, the 2030 is the perpetuity. It's the beginning of the perpetuity period, but that's just going to do 1 year. So when you do G for long term, that's the change in the assumptions tab, just the way we set up the model. Great question. Who else had a question? I saw another hand there a second ago.
I did, but you answered it there.
Okay, great. All right, well, again, good job, teams. You guys were able to kind of reuse the model that you built, which is great. So I think that was a lot of progress. So hopefully you're ready for your next week's assignment. So for the next week assignment, you can do a study buddy. So one person, not three. The company's Costco. Again, let me go back to sharing. Where is? I want to share. There it is. Okay, so under assignments, it's right here for Costco. So basically, this was the share price of the screenshot, 810.45 as of today. Basically, here's the data for Costco. Here is a BICO and a JP Morgan report. Here are the screenshots. So again, using your model, basically do the same process, valuation with the 4 models of Costco, as well as the write it all up, your changes, assumptions in a minimum 500-word paper. So you'll turn to those 5 files by next Tuesday. Hopefully pretty straightforward. This has been recorded. I will post the video by sometime tomorrow morning if you guys want to go back and look through any of this. And other than that, if you have any questions, let me know. But I'm going to give you guys back 15 minutes of your time tonight, and we are going to end a couple minutes early. So on that note, have a great evening, everybody, and I'll see you guys next week.
Thank you. See ya.
Thank you.
Thank you.
All right. Bye-bye.
Thank you.
Thank you.
Thank you.
Thank you.